I've been bullish on India for the last so many years that I have been in the business. Full disclosure, I'm an India bull. Whenever the world comes out of a global crisis, be it 2000, be it the GFC, or even be it COVID, one of the factors which does extremely well is value. And usually value outperforms every other factor for a period of 24 to 36 months. Over the last 12 months, apart from value, momentum has done extremely well. But over the last 2 to 3 months, momentum has slowed down. Since 2009, 5-year rolling returns, it's astounding that if you look at the Nifty 200, Nifty 200 is a benchmark. The quality portion of Nifty 200, quality 30 stocks out of the Nifty top 200, 82% of the time, they've beaten value.
The myopic vision for the investor today is to see the short-term returns. But if you actually tend to hold on to the quality stocks, I think in the long run, the outperformance or the alpha generation is something can be sought after. That is exactly, I believe, what queuing up quality is talking.
There are people who are saying that India is looking good. This is a segment which is, especially in the commodity stocks, this is a segment which is going to do very, very well. We've always seen that some of these stocks will correct, have to correct. The market always corrects eventually, or the market always balances out eventually. Quality is basically, when you invest, there are factors like the company should have a moat, the company should have a high ROC, there should be no debt, no leverage. Basically, a company which is doing extremely well. And you are trying to capitalize on the growth of that company. You're participating in the growth of that company. Titan and ICICI Bank have done well or marginally well. Value stocks like ITC and Hindalco have actually dipped. Come COVID, the situation changes. If you would have invested in 2020 and you would have seen your portfolio in 2023, Titan would have given you 172% absolute return. ICICI Bank would have given you 173% absolute return, point to point. ITC would have given you 162% return, and here is where it was astounding. Hindalco has given 332% return.
More than an AI could do, I think you have put insights on this entire thing. I mean, the way you have actually bucketed the stocks pretty much clears everybody's mindset on this.
Market Thalaivas brought to you by Sundaram Alternates.
Hello and welcome viewers to the second episode of Market Thalaivas. In this podcast series, you get an exclusive insight from Sundaram Alternates, one of the premium players in alternate market space. I'm your host, Reshmi Chakraborti from Sundaram Alternates. Today, we are diving into a strategy called factor investing. Sundaram Alternates has recently commissioned a white paper, Queuing Up for Quality, and we'll explore how the quality factor can deliver superior risk-adjusted returns compared to the value factor. We will discuss what makes quality a powerful factor, how it compares to others, and when it performs best. Joining us today, the stalwart, Mr. Vikaas M, Sachdeva, Managing Director, Sundaram Alternates, who will share the insights from the white paper and practical advice on incorporating the quality factor in crafting your investment approach. Hi, Vikaas. Can you start by explaining, before we delve into quality and value, can you start by explaining what exactly we mean when we say factor investing? And how is it different from traditional active and passive investment strategies?
Thank you so much, Reshmi. Thanks for having me. You talked about quality as a factor. You talked about how it adds value. It's interesting. You see, there is this quintessential debate which is happening in the industry. There are different slices of data, some of which says that quality does very well, some of which says value does very well. So we actually commissioned a research under the aegis of Sundaram Learning and Information Center. We commissioned a research wherein we asked an independent agency to look at the performance of quality indices and value indices across market caps, across time frames, in terms of what the performance has been. We just wanted to see what actually plays out, especially in an economy like India, in a market like India. And there have been some very, very interesting insights which I'll be happy to share with you.
Okay. But because I can completely understand when it comes to quality, factors like quality and all we talk about, from a layman's perspective, I would like you to emphasize on what is factor investing, first of all, because we will be talking quite a lot about factors. So what is factor investing?
No, that's a very good question. So I think we're starting from the start like this here, right?
Yes.
So basically, two of the most used terms are alpha and beta. Okay. Beta is basically following the index. Okay. You're buying the market. and alpha is you're beating the market. So the difference actually between the return generated over and above the benchmark is known as alpha, and benchmark
Right.
returns are known as beta. Now that's a very, very simplistic assumption. And normally when you talk to people, people analyze performances, they talk
Hmm.
about returns, they don't talk about risk adjusted returns. Okay.
Hmm. Hmm.
The other thing they don't talk about is how are these returns generated? What are the factors, quote unquote? And that is how the word factor investing has come in, to put it very simplistically. Is it momentum? Have you capitalized on a trend which is actually happening? Is it
Hmm.
low volatility? Is it quality? Is it value? Is it growth? Is it size? So these are six of the factors which are some of the most discussed factors.
Right.
When we talk about factor investing. So basically, factor investing is adding a layer, or let me just put it this way, it's deciphering the layer of alpha. What has
Hmm.
this alpha which has been generated? What has this increase over benchmark in terms of return which has been generated? What has caused it? Okay. Factor investing also allows you to plan your investments better so that you can make it more predictable, because markets are under nobody's control. Markets have a mind of their own. But
Hmm.
over a period of time, when you start extrapolating returns, when you start mapping returns over a period of time, you will find that there is some predictability which starts coming in. And the predictability is usually a factor. Like I said, two of the most discussed factors in the Indian subcontinent are quality and value. So, if I have to define quality and value, quality is basically when you invest, there are factors like the company should have a moat, the company should have a high ROC, there should be no debt, no leverage. Basically, a company which is doing extremely well, and you are trying to capitalize on the growth of that company. You're participating in the growth of that company. For all practical purposes, it's quality. Value, on the other hand, is a company which has been beaten down in terms of its price for a variety of reasons, and it is manifested in terms of low price to book, low price to earnings. One might say it's an out of favor company. Okay.
Hmm.
Uh, Typically, these are the two factors which are used to define factor investing. So that's the way we have commissioned the study to find out which of this is actually at play, what actually generates returns over a period of time, especially in the Indian subcontext.
Amazing. I mean, since you've been reiterating on the fact that Indian subcontinent, maybe it is too early to ask you this question, and already you have replied to my question on what is quality. For the sake of the viewers, a lot of narratives are coming up of late because current volatility in the market is one day we see it at its peak, another day we are not really knowing where it's heading. What do you think, apart from the two qualities, an investor should be keenly looking at while making or starting a portfolio of his own before we do a deep dive on the quality versus value kind of discussion?
No, absolutely. But I'd like to substantiate my answers with a bit of data. Insights are one thing, data-backed insights are quite another. Okay. So if you look at uh, typically what happens is, and this is what has been proven historically, whenever the world comes out of a global crisis, be it 2000, be it the GFC, or even be it COVID, one of the factors which does extremely well is value. And usually value outperforms every other factor for a period of 24 to 36 months, more 18 to 24, but at times it has gone to 30, 32 months as well. And one of the reasons is there's a gush of money coming in, usually governments support by a variety of measures, and liquidity gets infused into the system. And we've seen that in 2000, 2008, 2020, which actually gets into far more beaten down stocks. And that is what rallies the entire value segment, if you will. But I'd like to put it this way, but from one global crisis to another, okay,
Mhm.
after the first 18 to 24 months, the remaining period, quality does play a very strong factor. So if you start analyzing returns from say a 2 year perspective or a 1 year perspective, the jury is out there in terms of what factor has done well and what has not. But if you
Mhm.
start analyzing it over a 5 year rolling return period, you see a far more predictability going more towards quality than any other factor. So these are the two things. This is the first thing rather. The second thing is uh, we talked about these factors. Okay, these factors actually come in from a parent index. So if I talk to you about a Nifty quality 30, Nifty 200 quality 30, it will be probably you should understand that it is coming out of the Nifty 200 index. If I
Absolutely.
talk about a Nifty mid cap 50 quality index, it is coming out of Nifty mid cap 150.
Mhm.
Now, if you see these indices, juxtapose them with the parent indices. Okay, over a longer period of time, some of these factors like quality actually outperform these parent indices quite significantly. Again, it depends on what market cap you're talking about. You will
Mhm.
typically find that if it's Nifty 50, value tends to do a little better, over a period of time than quality. And if you deep dive, you double click, you'll find that the answers are because market exploration in terms of price is
Mhm.
far more finer in the Nifty 50. Whereas if you go down the curve, the market exploration in terms of price becomes a little bit more ambiguous, which is why people tend to lean more towards quality factors while investing in those stocks.
Amazing. I could. Okay. So, Vikas, how does this correlate? I'm just trying to understand how does quality and value correlate with the other factors that is already there in the market, momentum, size, and all. So, these two are the prime factors which I could understand that we are debating on. How do they correlate with all other factors together to make it happen in terms of an investor make it happen?
If you slice and dice the data, you will find that at different periods of time, different factors work. For example, over the last 12 months, apart from value, momentum
Mm-hmm.
has done extremely well. But over the last 2 to 3 months, momentum has slowed down. Okay.
Yeah.
Uh, if you're talking about size, then again, size has different slices of data which will support it, which will not support it. But why
Mm-hmm.
we focused on quality and value as two of the factors from the study point of view is primarily because A, they're the most discussed, and B, there is almost like a fanatic fan following for each
Mm.
of these factors. There are books written, there are people who espouse virtues about them. Okay, and if you go onto a social media platform like Twitter, you will find that there are some very strong comments which are made by the
Mm.
supporters of each of these factors. So we just picked up these two, said ki ye sabse zyada is happening, let's just discuss this, and that's exactly what has happened. Like I said, I can talk about the other factors as well, but this study which Sundaram Learning and Information Center has undertaken is primarily based on quality and value.
Correct. And it's the data we have currently backed is for quality and value. So completely understand on that. So the white paper showcases an in-depth analysis comparing quality and value factors. Could you
Yeah.
summarize the key findings of the comparison, some critical insights across the market cycles?
Sure, I think this is quite a big document.
Yeah.
You're actually asking my natural intelligence to become an artificial intelligence and summarize a big document. So I'll try to do that.
All right.
By the way, this document is available on our website. You could
Uh-huh.
click on to www.sundaramalternates.com and download
Okay.
that. And
Yeah.
happy to send it across to anybody who wants it offline as well. To answer your question in terms of how this is performed, what are the key tenets of this study? A, if you look at smaller periods of time, say calendar year returns,
Hmm.
okay, as to let's take the last 15 calendar year returns. And if you talk about how quality has done better as compared to value, it's pretty much the same. I mean, 57% of the time quality has done better, and 43% of the time value has done better, which means
Agree.
mota mota it's the same thing. You can't really distinguish between either factor. But if you take 5 year rolling returns, and this is the fun part, if you take 5 year rolling returns, and this study undertakes an extensive exercise in terms of looking at 5 year rolling returns since 2009. 2009 is when all the indices were in place. Some
Okay.
indices came in 2005, some indices came in 2009. Since
Correct.
2009, 5 year rolling returns, it's astounding that if you look at the Nifty 200,
Mm-hmm.
Nifty 200 is a benchmark. The quality portion of Nifty 200, quality 30 stocks out of the Nifty top 200, 82% of the time they've beaten value as a factor. Okay. If you look at the mid cap segment, Nifty mid cap, there's an index called Nifty mid cap 150. If you
Yes.
take 50 stocks, the quality stock is a quality 50 stock. If you take that, uh, 89% of the time it has beaten value. Okay. However, if you take a more if you take an index which is more towards size, you're talking about Nifty 50, like I mentioned to
Mm-hmm.
you. In the Nifty 50, the value 20, there's an index called value 20, 20 value stocks out of the Nifty 50, 81% of the time they have beaten quality over a 5 year rolling period. So the difference is quite stark. So the learning is the more broad based the index, the more
Understood.
price discovery which needs to happen, the better quality does. The more refined the index, the more price discovery has happened, value will tend to outperform quality. So that's the first part.
Hmm.
The second amazing sort of results which we've seen is that people always talk about returns. Like I mentioned, people never talk about risk adjusted returns.
Right.
So risk can be manifested in terms of various forms. We've looked at risk in terms of drawdowns. What have been the drawdowns during periods of extreme volatility? And there's some interesting data which we've collected. Uh, Let me just take certain stocks, okay, and then I can talk to you about indices also. But let me explain by virtue of certain stocks. Let's take a couple of stocks in, say, Nifty Quality, a couple of stocks in Nifty Value, some stocks in Nifty Mid Cap Quality, and some stocks in Nifty Mid Cap Value. Okay.
Okay.
So I'm just saying four different four different stocks, baskets of stocks, two stocks each in Nifty Quality, Nifty Value, Nifty Mid Cap Quality, Nifty Mid Cap Value. That should explain how things move. If you look at Nifty Quality, let's take Titan as a stock, and I'm going to take it across time frames of 2018 to 2020, 2020 to 2023, to 2020 being the inflection point in terms of COVID, and then the combined period of FY18 to FY23 in terms of CAGR. Yeah. So here are some of the findings. Titan as a stock has virtually not moved from 18 to 20, 2018 to 20. This is a quality stock, mind you. It's not moved at all. Okay. ICICI Bank has moved by around 17%. Okay. If you look at two of the value stocks around that point of time, ITC has moved by, actually has dropped by 30%, and Hindalco has dropped by 55%. Okay. So just to reiterate, Titan and ICICI Bank have done well or marginally well. Value stocks like ITC and Hindalco have actually dipped. Come COVID, the situation changes. If you would have invested in 2020 and you would have seen your portfolio in 2023, Titan would have given you 172% absolute return. Yeah. ICICI Bank would have given you 173% absolute return, point to point. ITC would have given you 162% return. And here is where it was astounding. Hindalco has given 332% return. So just full disclosure, we may or may not have these stocks. And this is not a recommendation for anybody to go and buy. It's just simple, pure data analysis which has happened. So I talked about FY18 to 20, FY20 to 23. So FY20 to 23 values done extremely well. But now let's just step back and see FY18 to FY23, wherein you had a pre-COVID period and a post-COVID period, wherein you have quality and you have value. And here is where the CAGRs start to astound you. Titan, for whatever people talk about that the performance has been marginal as compared to value stocks, Titan over the period 18 to 23, FY18 to 23, has given a CAGR of 22%. ICICI Bank has given a CAGR of 26%, which means that almost every 3 years your money is doubling. ITC, despite its stupendous performance, over a 5-year period, has given a 12.9% return, which is like virtually half of what an ICICI Bank has given. And I talked to you about Hindalco.
Yeah.
Hindalco has actually given a return of 14.3% over a 5-year. This is a CAGR for 5 years. So very clearly, if you look at a 5-year time horizon, you will find that quality tends to outperform value. A lot of discussion goes into recent returns, which is what most people start talking about. My 1-year return, my 2-year return, my 3-year return. And we have this discussion. Sundaram Alternates as a company focus a lot on quality as a factor. So we keep having these discussions. Mind you, I also mentioned to you that the world came out of a global crisis in 2020. So this again underscores that point. Let me just conclude the discussion, conclude this point by talking about mid cap. Okay. And I have certain mid cap stocks also. Now let me go the other way around. Let me talk to you about the return FY18 to 23 for 4 stocks. Okay. Astral. Astral as a stock is a quality stock, and Persistent Systems is a stock which we've identified as quality. And in mid cap value, you have SAIL, Canara Bank, and NHPC. Now, FY18 to 23, Astral has had a 27% CAGR return. Persistent has had a 48% CAGR return. And Steel Authority of India, Canara Bank are sub 10%. In fact, Canara Bank is 2% over a 5-year period. This is a PSU bank, which is always talked about in today's term. And NHPC is around 14.3%. Now, you know what are the returns from FY18 to 20 and 20 to 23? So I just mentioned to you Astral 27, Persistent 48, SAIL 6.4, Canara Bank 2.2, and NHPC 14.3, right?
Right.
Now, the returns in FY 2023, SAIL 308%, Okay. Canara Bank 225%. This is point to point absolute returns. NHPC 140%. But prior to that, in 1820, sale was minus 66%, Canara Bank was minus 65%, and NHPC is minus 18.4%. Of course, the astral numbers and persistent numbers are far lower, but I don't want to keep talking about numbers. Let me just labor the point. I don't want to labor the point beyond the time. Let me just highlight what I'm trying to talk about. That the
Mm-hmm.
drops are so sharp in value stocks. Okay, try which when extrapolated over a 5-year time frame, or if you look at a 5-year time frame and you put things in perspective, just makes that much more sense to look at quality. Okay, people just look at recent returns, and this is why the whole discussion starts happening. Sum and
Yes.
substance, whether you talk about Nifty quality or Nifty value, or you talk about Nifty mid cap quality and Nifty mid cap value, over a 5-year time frame, it will always tend to outperform. Quality will always tend to outperform value. And this is data in the public domain. Full
Mm.
disclosure. One of the things we are seeing is that Nifty PSU Bank Index over a 5-year time frame is 5.2% return CAGR. This is from 18 to 23. But from 18 to 24, if we just extend it by 1 year, Nifty PSU Bank Index is 16%. Okay. Conversely, Nifty Private Bank beats Nifty PSU Bank over a 5-year period, but actually underperforms Nifty PSU Bank by a little bit in terms of a 6-year time frame. So the markets are not perfect. Markets have their mind of their own. So you
Mm.
just data piece and say this is what is going to work. What we're talking about is a trend. What we're talking about is predictability. Predictability wise, quality tends to outperform value, but like I said, 81% of the time or 89% of the time, there will be surprises like PSU Bank Index.
Yeah, true. Agreed. Fantastic. I mean, more than an AI could do, I think you have put insights on this entire thing. I mean, the way you have actually bucketed the stocks pretty much clears everybody's mindset on this. In fact, I would also like to chip in here because that from our see the industry in the alternate space, I think 600 odd players in the PMS, like yesterday we were discussing 600 odd PMSs and 600 odd alternate. I mean, AI is operating there. The myopic vision for the investor today is to see the short term returns. But if you actually tend to hold on to the quality stocks, I think in the long run, the outperformance or the alpha generation is something can be sought after. And that is exactly, I believe, what queuing up quality is talking, if I'm not mistaken, if you can enlighten me on that.
Yeah, you're absolutely right. There is always a recency bias. In psychology terms, it is known as the halo effect and the horns effect.
Right.
Halo effect is the impact of something which has happened in the recent past, which has been good. And
Mhm.
horns effect, halo and horns is the angel and devil equivalent. Horns effect is something which has been a negative impact in the recent past, and it just tends to cloud your decision. And you're right, a lot of speculation, a lot of discussion happens around that. But
Mhm.
I have this favorite example. I keep talking to people. SRH has been one of the finalists this year in terms of IPL. Does anybody remember what was SRH ranking last year? Okay, you'll struggle. Okay, you just remember what has happened this year. You will just forget what happened last year, and people will talk about how good SRH has been, what has happened, etc., 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 without realizing that last year they were at the bottom of the table. Okay, so it's a recency bias. You can't help it, and this is what the human mind is all about, and this is what lends that sort of edge in terms of price discovery in the market. If you
Correct.
look at it the other way around, let's talk about P's. Some
Hmm.
of the P's in stocks today, some of the stocks are 100 P stocks. Okay.
Right.
Traditionally, you would not be able to even justify that, but there are people who are saying that India is looking good. This is a segment which is, especially in the commodity stocks, this is a segment which is going to do very, very well. We've
Mhm.
always seen that some of these stocks will correct, have to correct. The market always corrects eventually, or the market always balances out eventually.
So, coming back to the India story again, what is your future outlook? I mean, with the financial landscape constantly evolving, how do you see the role of quality factor changing in the coming years? I think we've been already talking a bit about it in your last conversation, but would like to know more on this.
It's something I can go on for the next 2 hours on, but I'll try
Yeah.
to talk to you about it in the next 2 minutes. Full
Mm-hmm.
disclosure, I'm an India bull.
Ah,
Okay.
okay.
I've been bullish on India for the last so many years that I have been in the business. I've been in
Mm-hmm.
India bull, irrespective of governments which have come and gone, because the structural story has evolved over a period of time. And I'm one of the people who's been fortunate enough to have a ringside view on that. Okay.
Right.
So I'm an India bull, whatever I say. The second thing you talked about, quality versus value. These are two factors. Like I said, there are a total of 6 factors, and
Mm-hmm.
uh, each factor will have its own place in the sun. Okay, why quality, to my mind, will do better in than value going forward is a price discovery will become better and better. Okay,
Mm-hmm.
most of these stocks which are, so there's a lot of money coming into the system. You're talking about SIPs coming to the extent of 20,000 crores. FIs will also put in money, so the broad-based index will start getting discovered beyond the top stocks. The market caps of these stocks will start going up, which is why companies which are doing well will start doing even better. And my favorite comment to this, people ask me, quality versus value, kya lagta hai, kya lagta hai? You know, if you go back and you Google and if you see on YouTube, there was an ad for Surf Excel, or for Surf.
Yep.
This is way back in the 90s. Surf was actually challenged by Wheel, sorry, by Nirma. Nirma had come up with this washing powder, and Surf was being challenged by that. So brilliant ad which came out, which started turning the fortunes of this particular brand. When this lady Lalita ji comes and she says, "सस्ती चीज और अच्छी चीज में फर्क होता
Perfect.
है." Okay,
Yes, I completely agree.
so
Yeah.
this is probably the best manifestation of quality versus value. You pay a little bit more for quality, but what you get is more predictability, lesser drawdown, a little bit more peace of mind. Value is not for the faint hearted. Okay, you can make very big money. Some of the world's best investors have been value investors. Okay,
Mm.
but it's a skill which is an acquired skill. If you want to have a more predictable return as an average investor, quality is the best bet. अच्छी चीज लीजिए, सस्ती चीज आपके हाथ में है, आपको पता नहीं क्या करोगे.
Wow, this is perfect. I mean, the ad and the correlation, I could actually see what you're talking about. Amazing, because that's amazing. So finally, the bet, what I could feel remains with the investors to decide on what bets they want to take, how they want to acquire at what price, and what is the bet they're looking at. So perfect on this. Any advice that you want to give to the investors, particularly on this trend of quality and value quest? What is it that you want to specially tell to the investors?
Okay, two things I'd like to tell investors. One is keep your financial advisor handy. He's the one who's going to make sure that your asset allocation is current. He's going to
Mhm.
make sure that when you start getting carried away by recent events, he pulls you back and he says, "Listen, stick to your asset allocation." I think the value of an advisor comes in when markets are not bullish, when markets are range bound, when markets are bearish. They control the sentiment, right? So you need to make sure that you have a good financial advisor. And the
Perfect.
second thing is, you may choose quality, you may choose value. Okay, you may choose whatever factor. I would always advocate quality over value, but assuming you think otherwise, the key thing is to stay invested in the Indian markets. Okay, these are the markets to be in for the next 10 years.
Mhm.
I think one might argue that the margin of safety in terms of drawdowns is probably lower in India as compared to anywhere else. The Indian markets could correct a lot more than, say, for example, the Chinese market. The flip side to it is there are a lot of positive factors which are now getting built in. And if you just see China, in 2008, China's per capita income was just about $2,000 per capita. They just crossed $2,000 per capita income.
Right.
From 8 to 24, they're nudging $16,000 per capita income. And Chinese markets have seen some serious drawdowns. We are currently at $2,200 per capita income. So whether it's quality, whether it's value, whatever works for you, just stay invested. Don't try to time the market. Markets are going to be volatile, but you are at the right place at the right time in the right country. It just can't get better than that.
It has been a wonderful discussion with you, Vikas. All throughout, you've been giving us so much of insights on quality and value. So, before we wrap up, is there any other key takeaway from your research that you would like to share with our investors or the listeners today?
I think I've shared enough from the research. What I would like to do is just an insight which I've gleaned over the years. I
Mhm.
think investors need to take a longer term view, need to be aware of what works for them. If volatility is something which would worry you, then maybe you need to look at a factor like quality. But just trade, just stick to your knitting. Okay, don't try to do too many things. People have made tons of money by just staying invested rather
Yes.
than just trying to time the market. Like they say, an event seems a big event over a period of one day, and it gets smaller and smaller in terms of memory as time goes by. 1 year down the line, nobody would even remember what for example, what is happening today in terms of elections, etc. 1 year down the line, it would be just a footnote in history. But what will count is your conviction in terms of getting into a stock or getting into a portfolio and sticking around. So that is pretty much what I think people should understand. People should understand their risks. People should understand what they're getting into. Ultimately, an equity share is you're buying a share of the company. So please study it. Please talk to people around you. Do not get into get rich scheme or something like that. You have to give it time to make money. If, for example, if you realize I'm talking about a minimum 5 year time frame, this analysis has happened. So people have to just be mindful of that. It just doesn't matter when you enter; it is how long you stay.
Absolutely right. Absolutely right. Because I completely buy you on that, because it is how long you stay. And like you said, it's equity. So you're having an ownership in the company. So before you own something, know about it well and stay invested is the key takeaway, what I could believe from this conversation. Thank you, viewers, for tuning into Market Thalaivas. Stay with us as we unpack the intricate world of factor investing and discover how focusing on quality can potentially lead to superior investment outcomes. To download the white paper or to learn more about quality as a factor, you can connect to us at our website www.sundaramalternates.com. Thank you.
Market Thalaivas brought to you by Sundaram Alternates.